Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. As companies and investors continue to navigate the 3D reset themes of decarbonization, deglobalization, and demographic change, Schroders believes that it is important to consider the practical investment implications of these broad trends. In 2024, Schroders sees investors transitioning from simply seeking ESG risk management and integration to an increasing focus on sustainable opportunities and themes to harness for value creation. As we begin Climate Week 2024 in New York, all eyes are on the decarbonization and climate transition trend, with climate mitigation investing often the largest focus. However, it is becoming increasingly obvious that investments in climate adaptation and resilience are also critical as we continue to see the physical effects of climate change on people and the economy continue to grow. One particular area that has been much in the news is insurance and the effect of climate disasters on the insurability of assets across different regions. The impact to real estate and other infrastructure continues to grow, changing the shape of the insurance market. At this time, there continue to be existing developments in the climate insurance and crop insurance industries, which create opportunities for adaptation and resilience-focused investment around the world. To shed more light on these developments, we have three investment professionals with us today. Irene Lauro is an economist at Schroders who focuses much of her work on climate issues. Christophe Etienne is a Senior Natural Catastrophe Specialist on the Insurance Linked Securities team at Schroders Capital. And Martin E. Diaz Plata is the head of private equity investments at Blue Orchard, which is an impact investment manager owned by Schroders and which runs the only private equity strategy in the world solely dedicated to climate insurance. Let's talk to each of them in turn and see how insurance-focused investing can contribute to climate adaptation and resilience. First up, Irene, as an economist specializing in the effects of climate change, can you set out the broader landscape for us? Specifically, can you tell us what has been the scale of change around rising physical risks and their impact on the economy?
Sure. Thank you, Paul. Thank you for having me on your podcast today. It's great to be here and talk about climate change, the impact on the economy, and the implications for the insurance industry. I think just to start, it's clear, it's becoming more evident that physical risks are rising as the world gets warmer. 2023 was the warmest year on record, and this upward trend in temperature has persisted into 2024, which with each month of this year recording a new record high. And earlier this year, the World Meteorological Organization released the State of Global Climate report, sounding the red alert to the world as some key climate indicators broke records. And in particular, we have seen new records broken for greenhouse gas levels, ocean heat and acidification, sea level rise, and glacial retreat. These are all alarming statistics that really want to emphasize the need for all countries to step up their efforts, not only to reduce greenhouse gas emissions, but also to adapt to a warmer and a wetter world. And all regions of the world are feeling the impact of global warming. We know that climate change is not evenly distributed among the globe. There are regions that are experiencing varying degrees of change and different types of extreme weather events. At the regional level, for example, Europe has been warming at an alarming rate, nearly twice as fast as the global average. And this makes Europe the fastest warming continent on Earth. And the continent is experiencing a record number of days with extreme heat stress. So if we move our attention to the other side of the Atlantic, to the US, we see that the US experienced a significant increase in climate events and in damages that these events do to the economy. So only last year, the US experienced a 28 climate disasters costing at least $1 billion. And that number puts 2023 into the first place for the highest number of billion-dollar disasters in a calendar year. And extreme weather events have a direct impact on the economy as they cause losses through infrastructure damage, disruptions in labor, but also declines in property values and agricultural output. And the data shows that the cost associated with climate disasters has increased remarkably over the past 4 decades, with hurricanes having the most damaging impact on the US economy, as shown on this chart here. And to put everything into an economic perspective, so to try to quantify these physical risks, over the past decade, climate disasters have accumulated a total cost of over $1.2 trillion to the US economy. So this is a staggering figure, as it accounts for around 5% of US GDP. And I think it's also worth to highlight that this is a very conservative estimate of how much extreme weather costs the United States each year, as these estimates don't reflect the total cost of US weather and climate disasters, but only those associated with events costing more than $1 billion in damages. So I think these findings really want to highlight the urgent need for swift action by policymakers to mitigate the risks of associated with climate change, so to reduce greenhouse gas emissions, but also want to highlight the need for improved strategies for adaptation, the need for to build a more resilient economic system to prevent and to minimize the disruptions from a warmer world.
Now, Irene, you've described an awful lot of impact from climate change. How has this affected the insurance sector of the global economy?
Sure. So parts of the world and parts of the US in particular are becoming uninsurable. And the link between global warming and the insurance affordability problems becomes more evident, particularly in the real estate sector. So the recent data is showing that climate change is becoming a challenge for insurers. And recently, we have seen a steep increase in insurance claim due to more severe climate events, particularly in the US, from wildfires to floods, storms, and hurricanes. These events have led to substantial losses and increased claims for insurers. So as a result, homeowners insurers have seen declining profits over the past few years in many states like California, Nevada, Connecticut, just to name a few. And in other states like Georgia, Florida, Colorado, and Iowa, insurers are making losses on homeowners insurance. Last year only in the US, insurers providing policies to homeowners suffered a net underwriting loss of more than $15 billion. That was the worst since at least 2000 and more than double the losses of the previous year. So these numbers really provide a critical market signal about the scale of the economic costs of climate disasters and implications for insurers. And a lower profitability has prompted insurers to make adjustments, such as raising premiums, limiting coverage, dropping customers, and in some extreme cases, even completely withdrawing from certain states highly exposed to climate disasters. So companies are starting to pull out of our high-risk states. We have seen it in California, where wildfires are prevalent, and states like Florida and Louisiana due to high flood risks. So this chart shown here shows that home insurance prices have been trending upward, making it extremely difficult for homeowners to find affordable coverage. In particular, insurance prices in 2023 increased by 20% compared to previous year, and they've risen by a staggering 55% since 2019. And climate change has played a significant role in driving up these costs, as extreme fires, floods, and storms have become more frequent and more severe. And obviously, these costs and challenges in securing home insurance coverage are hitting homeowners. Rising housing costs are likely to drag on household spending, but also are likely to put downward pressure on house prices in markets that are severely exposed to extreme weather events. And as a result, we could see home values suffer, and this could be a risk for the US housing market. Beyond the impact on individual homeowners, the instability of the US financial markets could be a broader concern. When insurance coverage is compromised, banks become more hesitant to issue new mortgages. So with fewer barriers in the market, the values of properties could decline, and that could result in reduced property tax revenues for communities. Just to give you an example, some recent academic research that tried to quantify the impact of flood risk on US residential real estate values finds that residential properties at risk of flooding were overvalued by over $200 billion. So climate change could be a challenge for the insurance industry, but at the same time, we believe that the insurance sector could play a critical role in mitigating these risks. Insurers are in the business of risk and have a great experience of dealing with new risk. Risk information is a fundamental part of the insurance business model. So the insurance industry has a unique role to play in addressing climate change by making society and policymakers aware of the risks and by making the economy more climate resilient. So, for example, insurers can encourage positive action on climate change by influencing the behavior of individuals, businesses, and governments, and help build climate resilience. They could develop innovative insurance products that incentivize climate risk prevention, for example, through offering lower premiums to policy holders that implement adaptation measures. These adaptation measures, such as anti-flood doors or early warnings system, can reduce the exposure to physical risks and insured losses. So we believe that by taking a proactive approach to risk management, insurers can not only protect policyholders from losses, but can also ensure the long-term availability of insurance products and reduce the overall cost of global warming.
Okay, so we've been talking about what insurers can do and what that industry can do in building a more resilient economy. What trends is Schroders seeing in climate finance, both public and private investment, as it relates to resilience and adaptation? I know I'm from southern Louisiana, and some of the counties or parishes is what they call them in Louisiana are still issuing 20 and 30-year municipal bonds, which take them out another 20 or 30 years into the trends of economic, climate, and environmental resilience and impact in those state economies. What kind of trends is Schroders seeing in the climate finance area around these issues?
Yeah, sure. So we see that climate finance has been trending higher. Developed countries mobilized almost $120 billion in 2022, up from less than $60 billion in 2016. But the trend that we are seeing is that so far, the focus of climate finance has mostly been on mitigation rather than adaptation. Most of the growth in climate finance has come from an increase in mitigation funding, particularly in the renewable energy sector and transport sector. So when looking at the overall breakdown of total climate finance mobilized by developed countries, adaptation finance has gradually increased its shares over the years, but is still lagging behind mitigation. So in 2022, adaptation finance accounted for 28% of the total climate finance mobilized in 2022. And this could be problematic because even if we limit global warming to 1.5 degrees Celsius as set by the Paris Agreement, we will still need to deal with the effects of climate change. We will still need to live with physical risks. Most of the major greenhouse gases stay in the atmosphere for many years after being released. So we will see extreme weather events hitting economies over the next few years. So climate adaptation is really essential as we still have to cope with the damages caused by a changing climate. And as these physical risks rise, the financial needs for adaptation will also rise. We see that the global adaptation funding gap is widening at an alarming rate, driven by the accelerating impact of climate change. So financing climate adaptation remains insufficient compared to the estimated annual needs of more than $200 billion by 2030 that are needed in developing countries alone. So bridging this gap will be crucial to ensure that communities and economies can cope with the impacts of climate change. And I think maybe we could see some news around finance and final targets and final goals at the upcoming COP29 that has been dubbed as the finance COP, as its main objective is really to set a new collective quantified goal for climate finance. And we see that current adaptation efforts are not sufficient to tackle the climate emergency, and adaptation is now growing in importance. So we could see more finance redirected to adaptation, to address adaptation in a warmer world.
All right. Well, thank you very much, Irene. We'll move on now to Chris, who represents an Insurance Linked Securities investment team, which specializes in natural catastrophe risk. Chris, it sounds like these climate and insurance-related issues are very relevant to your work. Please tell our listeners, how does ILS, that's the Insurance Linked Securities and Natural Catastrophe, how do ILS and natural catastrophe bonds in particular work as an asset class?
Yes. So hello, everybody. Hello, Paul. So basically, ILS stands for Insurance Linked Securities. And in short, these are securities or financial instruments which are linked to the world of insurance, right? And this allows the insurance sector to transfer some of these risks to the capital markets investors. And as you rightly said, Paul, I mean, these risks are mainly natural risks, so risks related to natural disasters. And here we're talking about hurricanes, earthquake, flood, wildfires, and so on. So this risk transfer can take different forms. I think the most common one is the one that you mentioned. These are the catastrophe bonds, or the CAT bonds, as people refer to them. Mm. But we also see some more private, so illiquid reinsurance transaction or industry loss guarantees. So there are separate different mechanisms for the reinsurance or insurance sector to transfer risk to the capital markets, but I would say the main one and the most common one are the CAT bonds. And I would say also for the investors, it's an asset class which is still, I guess, a niche, but it's correlated obviously to natural disasters and natural catastrophes. So it's decorrelated to the more traditional investments, right, which are obviously more correlated themselves to financial markets as a whole, or geopolitics. So that's kind of in short what the insurance securities, linked securities are, and what we're doing on a day-to-day basis.
So Chris, what is the impact of climate change on this asset class?
Well, that's a pretty broad question. I'm going to try to answer it with some examples here, but just, as a high level, ILS is exposed to natural catastrophes. So natural catastrophes are exposed to climate change, and therefore, we are exposed to climate change. I think that being said, I mean, the asset class is, and the insurance industry as a whole, by the way, is, I would say, fully aware of this climate change factor. And this topic is actually addressed, in all the conferences I've been attending, and all the debates that are taking place since, now more than a decade. And I think, I've put here 3 examples on your screen. A lot of people talk about climate change, but what is forecasted to happen on the climate change front? And it's linked to the extreme events, right? So here I've listed 3 findings from the scientific community. And if we go from left to right here, left, I think people might recognize and remember back in 2017, there was the aftermath of Hurricane Harvey, which, poured rain over Houston in Texas for 2 or 3 days in a row. And obviously these kind of incurred some heavy flooding that you can see on that picture. And that's, another signal that's been pointed out by authors right there, Knudsen et al., said that, the hurricanes in the future, or the cyclones in general, are likely to come with more rain, right? So they're going to be more wet from that perspective. So that's one finding from statement from the research in the scientific community. Another one is that the tropical cyclone and the hurricanes, for instance, are likely to move a bit slower, right? So it's not the overall wind speeds, but the speed at which the cyclone is translating. And here, that's an example of Hurricane Dorian back in 2019 over the Bahamas. So again, some people might remember that event. And you can see the number of all the dots on the screen. They represent 6-hour time windows, right? And as the storm moved from right to left on the screen, you can see that these dots kind of get closer and closer to each other, and that the storm actually almost stalled over the Bahamas for, I think, 15 hours in mind. So it was an extreme storm, and it stalled over the Bahamas, and obviously that didn't do any good to the poor people living over there, and obviously has a compound effect to the reinsurance and insurance industry, and also to the ILS sector. So that's a second example. More recently, the third example to the right is that storms in the future are likely to intensify more rapidly, right? And this is a storm from 2023, Hurricane Otis, which hit Acapulco. So here you see the points, which are again 6-hour interval points. They're still reasonably spaced, but from the color coding, and that's where the intensification is actually quite material. It transitioned within 1 day, so 24 hours, from a tropical storm in green at the bottom to a major, I think it was Cat 4 or Cat 5, so the highest scale on for the hurricane, right when it made landfall. And I think, that means it intensified. I think it was even maybe a record. I can't remember the numbers. But, storms in the future are likely to intensify that rapidly. And obviously that has some impact, on the preparedness over land, and obviously on, it poses some modeling challenges, because in this case, I do remember that some models didn't see that or didn't anticipate this intensification prior to landfall over Acapulco. So yeah, these are 3 examples, that we have the scientific community, we have some findings, and some of these findings have been observed in recent events. That doesn't mean necessarily it is, only due to climate change, but, there's a signal out there. And some recent events are there to remind ourselves that, something might be happening and we need to cope with that as a whole.
All right. So we've been talking about some of the new risks. What about the opportunities that get created from this kind of shift in the way storms are impacting communities?
Right. That's again a good question. Obviously, climate change for the insurance sector will come along with some challenges. It has already, but at the same time, in some places, there's the risk profile might change a bit, and this will bring obviously some additional challenges. But also, some places will, the demand of insurance is likely to grow, right? And as an ILS manager, probably we see that as a threat on one end, but also as an opportunity, as in some places, even those where, insurance penetration is not as high as in the US, for example, that, there might be some opportunities out there. Of course, time will tell exactly where, when, and so on. But yeah, it comes, two different directions, a challenge, but also maybe from an opportunistic perspective, something to be fully aware for insurance and ILS.
Okay. Now, how is the ILS team evolving its analytical process to allow for these ongoing climate-related changes?
Right. So that's another good one, and I guess we can stay on that slide too, because this provides some insight to that question. And I think, if you look at the top left, these are the type of perils that are material for the industry. And so you have quite a few, right? We have tropical cyclones, flood, wildfires, drought, tornadoes, winter storm, as well as earthquake and tsunamis. And I think here the 2 in red, earthquake and tsunamis, are obviously not impacted at all, as far as I know, and we know by climate change. So I think the message here is that all the weather-related cat events are obviously also potentially linked to climate change, but there are some other perils which aren't. And the 2 in bold here, tropical cyclone and earthquakes, these are the ones that are, the most relevant for the ILS community. So that's why I've put them in bold. And earthquake, it's not impacted by climate change, but obviously, as we've seen in the previous slide, tropical cyclones or hurricanes definitely are. So that's one point I wanted to raise, and also to the right, climate change and ILS. I think climate change is a gradual process, so that's how we see it, right? It's going to materialize gradually, so it's not going to come from one day to the next. So I think here that's what I mentioned here by short term versus long term. So climate change is we see that as a long term phenomenon, whereas our ILS instruments typically last 1, 2, or maximum 3 years, right? So there's a time scale difference here that is for us actually quite crucial from that perspective. So I think we've mentioned the opportunities, and also potential to access risk in other markets. And now to come back to your question, obviously, each ILS manager will handle that differently. So yeah, I guess if you ask different people, you might have some different answers. But I'm more from the analytic side. And first of all, we have to acknowledge that there's an additional challenge posed by climate change for our risk assessment exercises, right? So one obvious task for me is, as a natural scientist, right, is to stay tuned with the scientific community and the major findings that are available out there, being it in academic research centers or in the IPCC reports. So that's part of my job, obviously, and of course we also rely on external models to assess the risk. And our job also consists of understanding what's contained in these models and what's likely not to be included in these models. So we have to understand the limitations, and for each opportunity, we have to assess if the models are suitable to adequately price the risk, or if we need to reject it and adjust it a bit. So there's we could speak hours on what we're doing exactly. But I think it's important, the crucial role of modeling or assessing the risk is really here very important. And last but not least, obviously you need some qualified staff in-house to understand what's going on and to be able to digest that information and bring it in-house. We talked a lot about climate change, and I think it's gotten also a lot of media coverage, and it's quite, not to say trendy, I don't really like that word, but a lot of people talk about it. And that kind of eclipsed, from our perspective, other layers of uncertainty that we have in order to assess the risk. And here you can see the risk has 3 components. It's the hazard, it's the vulnerability, and it's obviously the exposures. So the building stack. And each of these 3 components, they do have their own layers of uncertainty. Obviously, climate change is under the hazard module, but you can see here, the exposures, they also have their own. We talk about building codes. We talk about the distance to the coast. So there's a lot of, the roof age. These are many examples. And when it comes to vulnerability, we also have, a lot of specifications there. If a house is made of wood or out of concrete, it will not resist to the same wind speeds. So I think it's important to put things into their context. We have numerous layers of uncertainty, and climate change is actually one of them, right? And just to highlight a bit this these layers of risk, I've put here a picture of Miami, and obviously, according to certain sources, in 10 years, the insured value along Miami Beach has increased by I think 40 to 50%. This is also inflation. So inflation is also playing a role in the losses that we would get from a hurricane if it would hit Miami. And maybe to conclude, I think you might be aware that in 2024 it was forecasted and is still forecasted to be a very active hurricane season over the Atlantic. And most of the forecasters, they actually used the El Nino Southern Oscillation Index. So the El Nino index, which is a shorter term phenomenon of 2 to 3 years. and it's shown to have, the most impact on the activity over not only the Atlantic but also in other basins. So, yeah, I think it's important. Climate change, we have to account for it, but there's plenty of other factors that come into play when properly assessing the risk from natural disasters.
So what I think I hear you saying, Chris, is that there are all kinds of other indicators that you need to integrate into your analytical process for the investment decisions that you and your team are recommending to investors that are just as important as any of the traditional economic indicators. And that's so important, I think, for people, for investors and financial advisors who are a significant part of our market to understand as this process continues to develop over time. Thank you very much, Chris, for your time today. And we really appreciate your participation in the program. And finally, we have Martin of Blue Orchard, which invests directly in climate insurance to fund adaptation and resilience. So, Martin, the poorest areas of the globe bear the brunt of climate disasters while receiving the least financing and resources to combat them. How does Blue Orchard address this specific dilemma and ensure that beyond impact, private capital is also generating returns?
Thank you, Paul. Well, I'm going to borrow from the presentations of my two colleagues at Schroders. But I started to state that, climate adaptation and resilience receive the least financing of the climate finance universe. And within that, developing markets receive the least financing in terms of climate adaptation and resilience, despite the fact, as you pointed it out, 85% of the most affected countries by climate change are in developing economies. Understand that some of the fastest growth in temperatures are happening in northern countries, but they are not boiling, as most of the countries in emerging market countries are. And sadly, together with that, these are the countries with the least penetration in terms of insurance. So what are we doing about it? With an idea that came out of KfW, the German Development Bank, in 2017. Blue Orchard created the first private equity fund dedicated to invest in climate insurance strategies. And I want to emphasize climate insurance as a strategy and not necessarily as a sector, because it is composed of different types of sectors, and it sometimes is embedded into another type of insurance or financing. So what we do is the following, is summarizing this chart in 3 sentences. I'm going to touch on a couple. The first is that we see a lot of growth in climate insurance. And this is important because our strategy is not a concessionary strategy. We aim to achieve market returns. And it is important for us to achieve market returns because we want this industry to be scalable, to be commercially profitable, because that is the only way in which we can attract private capital, and therefore the industry can continue to grow exponentially as it's been growing in the past decade or so. So that's the importance of this word, growth. We invest in fast-growing companies. And the second term in this sentence that I'd like to emphasize is value change, which enhances what I just said recently about the fact that the climate insurance encompasses several sectors. And if you quickly go to the third page, in which we have our portfolio companies together, and they are classed in 4 columns, which are 4 sectors, which are quite arbitrary. You can call them in another way. But we invest mostly in 4 subsectors. One is insurance companies. We own insurance companies in Cambodia, in Nigeria, in Ghana. And that is a very integral part of climate insurance, because they are the ones who actually confront that are facing the decline. The second is distribution. And distribution, I want to emphasize a trend that is very powerful, like InsurTech. The ability for people in emerging economies to contract insurance via an app and via a website, they will never ever see the sales insurance agent that perhaps we saw, 30, 40 years ago with a briefcase dressing very sharply. That will never happen. Insurance today is contracted through an app or through the web, and InsurTech is providing a great platform for growing climate insurance products. And the third column is enabling technologies. And here I want to borrow from Chris when he mentioned the sheer power of modeling and the ability for the climate tech industry to generate sources of information, because at the end of the day, this is about data, and some of them actually can be predicted to enhance the quality of the activities of insurance companies and reinsurance companies through better pricing of premiums and of course claims as well. So enabling technologies plays a very integral part of what we do, and we are investing in that area. And lastly, which I'm going to refer to later, perhaps when we talk about embedded insurance, is enabling financial intermediaries. Climate insurance as a product is really hard to sell. And therefore, we found out, particularly with farmers in terms of crop insurance, that if we can attach insurance into some sort of activity that the farmers require on a day-to-day basis, it can be more powerful. And that is typically financing. Farmers are always short of working capital, and therefore they always need financing. And if we can convince these finance providers to attach insurance into it, that's a very powerful way to increase the penetration of insurance in emerging economies. And the last thing that I will say about our strategy is that it's based on scalability and affordability. Because it grows, it needs to reach scalable. Because if we don't manage to sell affordable insurance products to emerging economies, what is the point? And therefore, we have now achieved a scale in some of these insurance policies. We're selling calamity insurance in the Philippines for less than $5 of premiums per year, and we are attaching insurance to cash flow financing in India for less than, again, $5 per year of premiums. So that objective of reaching affordability is essential to the success of climate insurance businesses.
So, Martin, I think what I hear you saying is that climate insurance can often be attached to other types of coverages that someone may have based on infrastructure or other kinds of risks. And what are the different kinds of, you mentioned a couple, but could you give us a couple more examples of the types of insurance that you consider for climate when you're talking to people or when you're looking for investors to support your activities in the private markets?
Yes, indeed, Paul. You are correct that sometimes climate insurance is embedded into other types of insurance, particularly, for example, property insurance, where all sorts of damages are covered. Sometimes motor insurance, people don't realize that sometimes they are covered by freak weather events, and not only because you crash your car, sometimes because there is a snowstorm and your car somehow gets damaged. So a lot of the insurance is actually provided, and I think we also have a role of educating the consumer that, by the way, you are covered by weather events, adverse weather events. But I'm going to focus on three that are typical climate insurance products. And I'm happy that, Chris mentioned one of them extensively, so I'm not going to focus too much on it. And the typical one is calamity, is disaster. And in the case of emerging economies, it's not hurricanes, it's sometimes cyclones, monsoons, etc. And the same data that Chris was providing about the intensity of frequency of hurricanes is happening in weather events in tropical economies. So calamity has a big part of climate insurance. And the second is agricultural insurance. Agriculture is an industry that depends on the weather, and therefore all sorts of crop insurance are considered climate insurance. And we own a few of these companies. We own one that is actually specialized in crop insurance in Brazil, which is the largest agricultural export in the world. And the last one that I'm going to mention is a typical climate insurance product, and it's the largest by far, is flood. And therefore flood affects all sorts of businesses, communities, people, etc., property, and flood is the typical weather insurance that we try to cover across our portfolio companies.
Okay, now we know that many private insurers are pulling out of coverage, as we've been discussing earlier, in certain regions and leaving governments to fill the gap. Blue Orchard, on the other hand, sees real investment opportunity for private capital in climate insurance. Tell us why this is the case from your perspective, and if you could give us another example of the kinds of investment opportunities that you're most excited about.
Indeed, and Irene actually mentioned it, and she's absolutely right that there are parts of the U.S. in particular, it was an example that cannot get coverage, or that coverage is too expensive, and that is happening in emerging economies as well. We believe that that's a small fraction of the pie. And most weather insurance event can be covered because of the growth of the industry is provided more affordability in terms of premium. What gets us excited? I mean, being the pioneer in the sector always gets us very excited. The fact that we are proselytizing climate insurance, and through our technical assistance and premium support programs, we're helping our portfolio companies to increase climate insurance penetration. But if I could mention three trends that are important in climate insurance that makes us particularly excited, is one, again, the development of better climate data through modeling, and that is impacting all our portfolio companies, which are developing products that did not exist a few years ago. But within that, a couple of activities that are very powerful. One we mentioned already, which is embedded insurance. As an example, we own a provider of cash flow financing to retailers in India. India has more than 20 million retailers, small retailers. 99% of them are not covered by flood insurance, which is what typically destroy their businesses and their livelihoods. And we are attaching in all of their loans embedded flood insurance. And that is happening in Africa, in Latin America, where we're finding this business in which we can attach embedded insurance. And lastly, I'm going to finish with something that for people who are familiar with climate insurance might be old news, but for the general public is not, is the tremendous power of parametric insurance. And parametric insurance, some people say that it might not even be called insurance itself, because parametric insurance is basically the ability to provide payments in case on weather KPIs happen. In layman terms, for example, if your plot of land receives X amount of rain, in excess of that, or in excess of X, or in a deficit of X, you get a payment, no questions asked. And this is important because one of the big things that the insurance industry has to overcome is trust. Are they going to pay me? How much am I going to go through in order for me to get a claim? So with parametric insurance, in combination, by the way, with mobile payments, a farmer or a small business could actually receive a payment through their mobile because a weather event has happened and they didn't actually have to go through the pain of a claim exercise. So parametric insurance certainly is something that is growing, and is probably the single most important factor that is revolutionizing climate insurance today.
That's a really interesting process that people who are purchasing insurance can also get paid for having the insurance and the embedded parts of coverages. So it's always a creative industry. And thank you very much, Martin, for your comments today. Please note to our followers of the Sustainable Finance podcast that you can learn more about the opportunities being explored by Schroders and Blue Orchard's teams on the firm's websites, and can write into the Sustainable Finance podcast with any questions that you have about the topics that we've discussed in today's podcast conversation. And we can put those followers in contact with Schroders and Blue Orchard as it's appropriate. Thanks again to Irene, Chris, and Martin from Schroders and Blue Orchard for joining me on today's episode, and stay tuned for future conversations with the Schroders Sustainable Investment Team in 2025 and beyond. I'm Paul Ellis, and this is the Sustainable Finance Podcast.